In the relentless world of global food trading, speed has always been a competitive edge. But in our current climate of hyperinflation, hesitation isn't just a missed opportunity, it's a rapidly escalating financial burden that can erode profits and destabilize even the most robust supply chains. For businesses operating on razor-thin margins, every delayed decision, every prolonged negotiation, directly translates into tangible losses. Hyperinflation, characterized by a rapid and uncontrolled increase in prices and a corresponding devaluation of currency, creates an exceptionally challenging environment for long-term planning and fixed-price contracts. The traditional buffers and timelines that once provided a sense of security have all but vanished. The multiplier effect of delay. Consider the following critical impacts of delaying deals in a hyperinflationary environment. Eroding purchasing power. The most immediate and devastating effect is the rapid erosion of your capital's purchasing power. If you delay a purchase of, say, 500 metric tons of wheat, the price tomorrow, or even a few hours later, could be significantly higher due to currency devaluation and rising input costs for the producer. The money you had set aside for that deal simply won't buy the same volume. Escalating supplier costs. Your suppliers face the same inflationary pressures. Their costs for raw materials, energy, labor, and logistics are increasing by the day, sometimes by the hour. A quote provided this morning might be obsolete by the afternoon. When you delay, you force your suppliers to reevaluate their pricing, almost invariably upwards, to cover their own rising expenses and maintain their margins. Unpredictable freight and logistics. The cost of transporting food commodities is particularly susceptible to inflationary spikes, driven by fuel prices, labor shortages, and geopolitical events. Locking in favorable freight rates becomes a race against time. Delays mean requoting, and requoting almost always means higher shipping costs, eating further into your profitability. Currency devaluation risk. For international deals, currency fluctuations become a magnified risk. If you are importing goods and your local currency is depreciating rapidly, every day of delay means you'll need more of your devalued currency to purchase the same amount of foreign currency required for the transaction. Similarly, exporters holding off on converting foreign currency earnings might find their domestic value diminish before conversion. Loss of competitive advantage. In a volatile market, agility is key. Competitors who act decisively to secure inventory or lock in prices will gain a significant advantage. By hesitating, you risk being outmaneuvered, potentially leading to shortages of critical commodities or forcing you to purchase at inflated prices later. Contractual complications and renegotiations. Prolonged negotiations in an inflationary environment often lead to a constant need for contract revisions. What was agreed upon a week ago may no longer be economically viable for either party, leading to strained relationships and potentially legal complications if terms cannot be amicably adjusted. How hesitation harms your overall investment. The concept of hesitation in a hyperinflationary environment extends far beyond just food trading deals. It significantly impacts your overall investment portfolio. Hyperinflation is a ruthless destroyer of value, and any delay in making strategic investment decisions can lead to substantial, often irreversible, losses. Here's how hesitation hurts your overall investment. Erosion of purchasing power, the silent killer. Opportunity cost of waiting and seeing. Increased volatility and uncertainty. Negative real returns on many assets. Even if your investments show nominal gains, the key is the real return, what you gain after accounting for inflation. In hyperinflation, many conventional investments, like broad market stocks, can still deliver negative real returns. Delaying a re-evaluation of your portfolio's composition can lead to a steady decline in your actual wealth, even if the numbers in your account look stable or slightly positive. Erosion of capital for future endeavors. Whether you're saving for retirement, a child's education, or future business expansion, the capital you have today needs to maintain its purchasing power. If hesitation causes your investments to lag significantly behind the inflation rate, your accumulated capital will simply not be enough to achieve those future goals. You will effectively have less money, in real terms, for future investments or expenditures. Strategies for mitigation. The power of a prepared team. While the challenges are formidable, food traders and investors can adopt strategies to minimize the impact of hyperinflationary delays. And central to these strategies is the power of a reliable and prepared team. Having a well-drilled team makes you better every day and allows you to pull the trigger effectively when timing is everything. Here's how. Expedited decision-making. A prepared team empowers rapid, informed decisions. They've streamlined approval processes and minimized bureaucratic bottlenecks, enabling quick action when market conditions demand it. For personal investments, this means having a clear strategy and acting swiftly on opportunities identified. Shorter contract windows. A proactive team can negotiate shorter validity periods on quotes and contracts, reducing exposure to long-term price volatility. This might mean more frequent negotiations, but it's a trade-off a ready team can manage. Effective hedging strategies. A knowledgeable team can explore currency and commodity price hedging instruments effectively, navigating their complexities even in hyperinflationary scenarios. Strong supplier relationships. Nurturing robust relationships with key suppliers is easier with a cohesive team. Transparent communication about market conditions, facilitated by a prepared team, can lead to quicker, more understanding negotiations. Dynamic pricing models. A flexible team is prepared to implement and accept more dynamic pricing models that allow for quicker adjustments based on real-time market conditions, ensuring agility. Close monitoring of economic indicators. A dedicated team stays abreast of inflation rates, currency movements, and commodity price indices. They leverage data analytics to anticipate trends and react swiftly, turning information into actionable insights. Diversification into real assets. For your investment portfolio, a well-informed team can advise on diversifying into tangible assets that historically perform well during inflationary periods, such as real estate, commodities, and potentially inflation-linked bonds if they offer true inflation protection. In the current hyperinflationary landscape, the adage "time is money" has never been more profoundly true for global food traders and investors alike. Hesitation is no longer a minor misstep, it is a direct path to financial erosion. Those who cultivate a culture of decisive action, supported by a reliable and prepared team that's ready to execute, will be the ones who navigate these turbulent waters successfully, securing essential commodities, maintaining their profitability, and preserving their overall wealth. Is your team prepared to face the challenges of hyperinflation head-on and make every second count? You can count on us at globalfoodtraders.world.